Welcome to the channel. As I stated in my previous videos, you have to study the past in order to see the future. Today I want to talk to you about the role of the Federal Reserve and how it's considered one of the most important financial institutions in the world. Its monetary policy and decision makings can send waves throughout not only the U.S. markets, but also the rest of the world. The Federal Reserve has a dual mandate of ensuring price stability, limiting inflation, and achieving maximum employment. It also regulates the activity of banks and aims to protect consumers. The Federal Reserve operates under a mandate from the U.S. Congress. However, Congress granted autonomy to the Fed with the intention of allowing the central banks to carry out its missions in the absence of political pressure. Although this independence has been tested at times throughout history, the Fed's three sections, the Federal Open Market Committee, the Board of Governors, and the Fed's regional banks maintain independence from the federal government as they fulfill their responsibilities. Let's talk about the results of the Federal Reserve power in the last 110 years. Every major economic downturn of the last 110 years bears the mark of the Federal Reserve. In fact, as long as the Fed has been around, it has swung the economy between inflation and recession. Yet Americans surprisingly have tolerated it. The Federal Reserve operates with a high degree of independence from the government, which can make it difficult to hold the institution accountable for its actions. The Fed's focus on short-term economic goals can lead to neglecting long-term consequences, such as the buildup of debt or the creation of asset bubbles. Since its founding, the Fed has stolen 98% of the value of a dollar. It has used those profits to repeatedly launch boom-bust cycles and to transfer treaties to the federal government, special interests, and wealthy borrowers. Now I want to talk to you about the steps we took to get to creating the Federal Reserve System. A new nation, 1775 to 1790. To finance the American Revolution, the Continental Congress printed the new nation's first paper money, known as Continentals. The notes were originally intended to be redeemable on demand in spaces. However, the Congress reneged on its promise and issued notes in quantity that led to inflation, which, though mild at first, rapidly accelerated as the war progressed. Eventually, people lost faith in the notes, and the phrase "not worth the Continental" came to mean utterly worthless. After the Revolutionary War ended, the nation had substantial debt, a significant portion of which was issued by the individual states. There was no common currency, as many states printed their own money. These were two of the chief financial problems facing the nation's founders around the time that the Constitution was written. Alexander Hamilton thought having the federal government take over the states' war debts would be a good way to fix these problems while establishing federal power preeminent over that of the states, another of his goals. The first Bank of the United States. The Constitution itself prohibited state governments from issuing their own currency. The Bank of the United States was conceived in 1790 to deal with the war debt and to put the government on sound financial footing. It was intended to help fund the government's debt and issue currency notes. Hamilton, then President George Washington's Treasury Secretary, was the architect of the bank, which he modeled after the Bank of England. Though the intent of the bank was to facilitate government finances, Hamilton had another goal in mind: to function as a commercial bank. At the time of the Revolution, there were barely any banks in the colonies. Britain had used its authority to protect its own banks and prevent the development of financial rivals. Hamilton's vision was to create a central source of capital that could be lent to new businesses and thereby develop the nation's economy. So while in some ways the first bank prefigured the Federal Reserve, it also differed from slightly by offering commercial loans, which the Fed, along with most modern central banks, does not do. The Second Bank of the United States. Andrew Jackson and the Bank War. The first Bank of the United States had a 20-year charter that expired just before the War of 1812. Disaster was barely averted in that war against Britain thanks to a few key battlefield wins. But the inability of the federal government to wage a war without a bank was made abundantly clear. When the war was going badly, even strong opponents of a central bank, such as Jefferson's political allies, thought a centralized bank was needed for an extended war. The Second Charter Bank of the United States was signed into law in April 1816. It opened for business in Philadelphia in 1817. Similar to the First Bank of the United States, the Second Bank was a fiscal agent holding federal deposits and issuing debt. It issued and redeemed banknotes that were deposited in state charter banks. It also operated as a commercial bank by accepting retail deposits and making loans to individuals and business through its 25 bank network. Andrew Jackson, who was a follower of the Jefferson line and his views on the role of government, saw the banks as too powerful, too insulated from congressional oversight, and too harmful to states' attempts to manage their local economies. In addition to Jackson's political objections, he also distrusted banks in general as dishonest players in the economy. At his urging, the Second Bank's charter came up for renewal ahead of schedule in 1832. It passed in the House and the Senate, but then was stopped as Jackson vetoed it. I want you to remember that insight on Andrew Jackson's and his distrust for banks. National banks, 1863 to 1913. The outbreak of civil war and the needs to finance it led again to their renewed interest in the national bank. But this time, with the lessons of the Second Bank, the designers took a different approach. Modeled on the free banking system in 1863, they established what is now known as the national banking system. The new system allowed banks to choose between a national charter and a state charter. With a national charter, banks had to issue government printed bills for their own notes, and the notes had to be backed by federal bonds, which helped fund the war effort. In 1865, state bank notes were taxed out of existence. Thus, in spite of all previous attempts, this was the first time a uniform national currency was established in the United States. The three different bank panics that led to the creation of the Federal Reserve after 1907. While the national banking system served its role in financing the war and established a uniform currency, it was fraught with at least one bank panic in every decade after the Civil War. A bank panic will often begin when depositors will learn that their bank was unable to meet withdrawal requests. This in turn caused a run on the bank, in which a large number of depositors attempted to pull out their money, causing the otherwise solvent bank to fail. Seeing this, depositors at other banks were led to withdraw their funds, causing a system-wide panic in 1893. A bank panic coincided with the worst depression the United States had ever seen, and the economy stabilized only after the intervention of financial mogul J.P. Morgan. After another bad panic and ensuing recession in 1907, bankers in the Congress decided it was time to reconsider a centralized national bank, laying the groundwork, 1908 to 1912. This reconsideration led to Aldrich's Virulent Act of 1908, which provided for emergency currency issues during crisis. The act also established a National Monetary Commission to search for a long-term solution to the nation's banking and financial problems. The 1912 election of Democrat Woodrow Wilson replaced the Republican Aldrich plan, knew what was to emerge as the Federal Reserve Act of 1913. Though not personally knowledgeable about banking and financial issues, Woodrow Wilson solicited expert advice from Virginia Rep. Carter Glass, soon to become the chairman of the House Committee on Banking and Finance, and from the committee's expert advisor, H. Parker Willis, formerly a professor of economics at Washington Lee University. Throughout most of 1912, Glass and Willis labored over a central bank proposal, and by December 1912, they presented Wilson with what would become, with some modifications, the Federal Reserve Act. From December 19th to December 1913, the Glass-Willis proposal was hotly debated, molded, and reshaped. By December 23, 1913, when President Woodrow Wilson signed the Federal Reserve Act into law, it stood as a classic example of compromise, a decentralized bank that balanced the compromising interests of private banks and populist sentiment. The rundown on how the events that led to the creation of the central bank. Now, I want you to remember the war Andrew Jackson launched against forming the central bank. I want to play a video to highlight the secrecy of the banksters and how they created the Federal Reserve. Again, this channel will always talk about the past in order to understand the future. Be blessed.
In November 1910, a group of America's wealthiest and most powerful men met in secret on a secluded island. Their mission was not to govern or legislate, but to create a banking system that would change the course of American history forever. Little did the public know that this meeting laid the groundwork for the enslavement of the entire country through national debt. And it all began on Jekyll Island. 6 men boarded a private train under false identities, bound for a secret meeting on Jekyll Island, Georgia. Their names were Nelson Aldrich, Abraham Piatt Andrew, Frank Vanderlip, Henry Davison, Benjamin Strong, and Paul Warburg. Each of these men wielded enormous power. Aldrich, the senator who controlled the nation's monetary policy. Vanderlip, head of what would become Citibank. Davison, representing J.P. Morgan's interests. Warburg, a successful German-born financier who was a partner at the investment bank Kuhn, Loeb, and Co. Together, they represented the wealthiest banks in America. This was no ordinary meeting. These men had been called together by Aldrich to secretly design a new central banking system. They would later present it as a way to stabilize the economy, but in reality, it was designed to give private banks immense power over the nation's money supply. At the time, America had faced repeated financial crises, bank runs, and instability. The public demanded reform, but Aldrich and his associates had a different agenda, one that would benefit the banks more than the people. Their plan: the creation of a central bank that could print money, control interest rates, and lend to the government. They called it the Federal Reserve. The Federal Reserve Act was written in secret, away from public scrutiny. For 3 years, the plan was carefully hidden, and when it was finally ready to be passed, Aldrich and his allies worked quickly to push it through. In a particularly shady move, the Federal Reserve Act was passed on December 23, 1913, 2 days before Christmas, when most of Congress had already left for the holidays. With very few representatives present, the act slipped through quietly, ensuring that the public wouldn't have a chance to fully understand what had just happened. President Woodrow Wilson signed the act into law, and with it, the Federal Reserve was born. Wilson would later regret his decision, writing that he had unwittingly ruined his country. But by then, it was too late. The creature had been unleashed.
Island, what is the Federal Reserve and what is your answer?
Well, what it is, it's a cartel. It's not a government agency. It has the appearance of it being a government agency, and they went to great lengths to give it that facade. It does have the power of government because Congress voted to give the power of enforcement to it. But in its essence, underneath it, it's a cartel. It's nothing different than a banana cartel or an oil cartel or sugar cartel. It happens to be a banking cartel. They got together, they drew up the rules and regulations for their own industry, to self-regulate their own industry is what cartels do, and then they sent it to Congress, and they took off the label at the top that said banking cartel, and they erased that, and they said Federal Reserve Act. Congress passed it into law, and that's why we think it's a government agency, is because if you don't obey the rules that they set down for their own industry, you go to prison. And so it looks like a government agency. But basically the answer to your question is, it's a banking cartel.
The Federal Reserve was created to stabilize the economy, but its true effect has been the exact opposite. Instead of reducing debt and crises, it allowed the U.S. government to borrow more than ever before. Over the next century, the national debt exploded, climbing into the trillions. The Federal Reserve System works like this. The government borrows money from the Fed, which is created out of thin air. But it doesn't come for free. The government has to pay interest on every dollar borrowed. And where does that interest come from? Taxes. Your taxes. The result? Every American is on the hook for a debt they never consented to. The more the government borrows, the more we pay in taxes, the more our currency is inflated, and the more we become trapped in a system that only benefits the wealthy elite.
Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else.
For decades, politicians have promised to reduce the national debt. But the truth is, they have very little control.
Can you give me a rather quick answer on this? Do you have any idea what percentage the base should shrink or might shrink? Or is that something that you don't even want to address?
No, I think we would like to bring the balance sheet back to something consistent with where it was before the crisis, which means enough to accommodate Americans' demand for currency, plus a modest amount of reserves in the banking system. And that would suggest something under $1 trillion, I think, would be
$1 trillion?
Or less, yes.
Okay.
The real power lies with the Federal Reserve, an institution which was designed to operate independently of the government. This means that, while politicians come and go, the bankers who control the Fed remain in power, manipulating the economy from behind the scenes. These unelected officials, people you've never voted for, control the money supply, set interest rates, and dictate the value of the dollar. The system was created to give the illusion of democratic control, but in reality, the reins of power are held by private bankers.
As I said before, keep your eye on one thing and one thing only, how much government is spending, because that's the true tax. Every budget is balanced. There is no such thing as an unbalanced federal budget. You're paying for it. If you're not paying for it through it in the form of explicit taxes, you're paying for it indirectly in the form of inflation or in the form of borrowing. The thing you should keep your eye on is what government spends. And the real problem is to hold down government spending as a fraction of our income. And if you do that, you can stop worrying about the debt.
Here's how the trap works. The government borrows from the Federal Reserve to fund wars, welfare programs, and infrastructure. But that money isn't free. It comes with interest. To pay off that interest, the government borrows even more, plunging deeper into debt. Meanwhile, wages stagnate, inflation rises, and the cost of living increases. Americans are forced to work harder just to stay afloat, all while the national debt spirals out of control. And the more debt the government accumulates, the weaker the value of the dollar becomes.
This is what happens when you have a quantity of something and then you add more to it. This is dilution. The principle is so simple that a child can understand. And you can create this little science project at home. The principle is called dilution. And when you print $5 trillion and you put it into the economy, you have diluted the value of the money. So for instance, if you had a minimum wage at some amount and somebody was making minimum wage and they were still making minimum wage after this money was printed, they actually are making considerably less in terms of real dollars. It's dilution.
But is there a way out? Some believe that reforming the Federal Reserve, or even abolishing it altogether, is the only way to break free from this debt trap. Others argue for a return to the gold standard, a system that would limit how much money the government could borrow.
If you could, if we could make you dictator, would you abolish the Fed?
Yes.
You would?
Yes. I mean, for the reasons I just gave, the history. There's no, the Fed represented wonderful hopes, but we've had so many programs that represented wonderful hopes that ended in disaster. I don't doubt that someone who is sufficiently scholarly could come up with examples of where the Federal Reserve made things better. The question is, overall, what was it supposed to do? It was supposed to do not only prevent bank failures, it was supposed to prevent huge changes in the money supply, in particular, great deflations.
Right.
The greatest deflation in American history occurred under the Federal Reserve System.
The decisions made over a century ago on Jekyll Island still haunt us today. The national debt is not just a number. It's a burden on every American citizen. As long as the Federal Reserve exists in its current form, the cycle of debt will continue, and the American people will remain enslaved by a system that serves the few at the expense of the many. The creature from Jekyll Island was born in secrecy, but its effects are felt by all of us. The question is, will we ever be able to tame it?
So who's financing the government? Government is financed by treasury bonds, paper. And who buys the treasury bonds? Mostly the Fed. And how does the Fed buy them? By printing money. But what backing does the Fed have for that money being printed? The treasury bonds themselves. So basically, you finance the government by printing money out of thin air. Bitcoin! Someone could ask, well, so if the government can print the limited amounts of money out of thin air, why do they collect taxes?